to be successful will be given to you in the first hour. I'm going to encourage each and every person in here to keep it simple, especially if you're brand new. You are walking up to the most magnificent buffet you've ever been to. And there are so many ways for you to find happiness. Guys, go to the first thing first and eat it and enjoy it, and then go to the next thing. And that's kind of what we do. And I stink at analogies, and that was a pretty bad one. So I'm going to go to the trading guide right off the education room. And guys, this is where the rules are that we talk about each and every morning. This is where the glossary of common terms is. This is where getting that trade tracking sheet. This is where doing management, prop firms, tracking sheets, market replay. Guys, all the answers are here. We go to great lengths to not hide anything from you. But the way I teach this class, guys, it's a very specific recipe. I'm going to share it. I actually made a video about it yesterday. And it's just a little 30-second video. But guys, I teach this class every morning, and we talk about 3 rules on a high probability trend trade. You know what? We'll go to this one in a second because I want to do that. I want to let you know what a high probability trade is, guys. This is important, especially my new users. A high probability trade, guys. This is a trade where each indicator on every chart agrees for the rules, guys. This is the strongest triggers. Nothing in the way, nothing between you and your targets. Guys, gentlemen, when you were in 8th grade, this is the girl that already told your best friend she likes you, and all you got to do is go ask her out. It's the easy one. This is the trade, guys, that typically wins 70 to 80% of the time. This is the trade that's going to teach you to read your indicators, and this is the most important thing. You're going to learn to look at your charts and understand what's going on. You're going to be able to take it and say, all right, here's my advantages, my rules are met, it's time to take a trade. Jen, some days I'm wittier than others. I'm feeling soapboxy today, guys. Watch out. Once you learn to read your indicators, this is like the greatest skill that nobody can take from you. And when you learn to read them, especially using that high probability trend trade, guys, you're going to understand where the market is likely to continue. This becomes your entry initially. You're going to know where the market's likely to go. This is going to be a great spot for targets. And you're going to understand where the market is likely to stop. And guys, this is going to pay handsomely over and over and over, because one of the advantages that Nexgen users have is the ability to see these key areas on your large chart where the people in charge are going to make decisions, where markets may reverse, where things may stop. Good morning, Trading Book. So your first goal is to become a chart reader. My job in this room is to turn you into a chart reader. So we're going to work together on this, and we're going to initially do it with what we call the high probability trend trade. The high probability trend trade is 3 rules. Each rule creates an advantage. Guys, the first 2 rules, momentum and a clear path, these are the rules that are going to carry you next level. These are the rules that are going to make trading easy. These are the rules that you've got to commit to learning right off the bat. And then once you've got them, you're going to see doors open. Initially, our 3rd rule is going to get us into the market at the point where the market is most likely to continue, guys. We're going to use these 3 rules, and we're only going to do it on 2 charts. We're going to use a large chart and a small chart. How's that for technical? The large chart is a slow-moving train. It's a broad stroke of a brush. It's difficult to see change on the large chart, but it will define the direction of the market. It'll let you know whether you should be looking for rules to take high probability trend trades long or high probability trend trades short. It's going to define the momentum in the market through rule number 1 and let you know whether or not you have a market condition that suggests the market's likely to continue in the direction of the trend. And then finally, it's going to define those key areas, those points where the people that move the market are going to make decisions. And guys, your first 2 rules are going to happen on that large chart. Don't even look at a small chart. Guys, you could keep a small chart minimized until you have momentum and a clear path. But once you do, rule number 3 for the highest probability trend trade you can take, guys, this is the rule that is going to define exactly where the market is most likely to continue so that you can enter and go with the trend and go with the momentum and go with the clear path. And we use these two charts because they really are a direct reflection of who's in charge. And you're going to hear me say the large crowd a lot, the people with money. Guys, the large crowd is so much bigger than you'll ever be. The large crowd, the men and women with the deepest pockets, they create the trends. And if they wake up this morning and they go, you know what, I think the S&P should go up, it's going up. These are the same people that establish the momentum that we look for, and these are the same people that react to those key areas. And guys, one of the biggest advantages that this software gives you is you can put yourself where you are never in a position to get caught up in their decision making. I won't say never, usually not. You can put yourself in a position where you've always just going with the flow. And then there's a small crowd. This is your small chart. And the small crowd has money, still more money than you. And they like to fight. They put their dukes up every day. I think they have a drinking problem. I'm not trying to start rumors, but maybe they do. And when these guys say up, and these guys say fast, and these guys say nothing in the way, these yahoos push. They take a little bit of that money and they try to make it go down. And guys, these guys fail 70 to 80% of the time. 70 to 80% of the time, these guys just can't get the job done. You're going to use your third rule on this smaller, faster chart to pinpoint exactly where they're likely to fail. This becomes your entry for the highest probability trend trade, guys. And this is what we're going to focus on for the first hour. So I want to share this. Why do I teach like I do? What to expect, especially if you're a brand new user. The class is designed to teach you these three rules on only two charts, and what it's going to do is it's going to give you the skill set to recognize advantages and turn them into trade. Everything that we do, we have an edge. That's why it's a rule. Strong triggers, no termination conditions, and then finally that high probability entry. Once you can recognize momentum, the first rule, you're capable of seeing a market that's likely to continue in the direction of the trend, and on its own, momentum is a powerful enough advantage to find and take trades, guys, in smaller size, quicker profits. When you couple that advantage with what we call a clear path, none of those areas that are likely to stop the market, not only will you have a market that can push in the direction of the trend, but there will also be no key Fibonacci areas in your way to create a bounce. And guys, picture a semi-truck doing 100 miles an hour down the highway. That's the first two rules put together. That's hard to stop. And those two ideas alone are enough to create a trading plan that is consistent and profitable. Study them, learn them, commit to them, and then once that recognition becomes second nature, you're going to find your best entry. You're going to find the way that suits your needs. But until you do, let me take a sip of water here. Until you do, guys, the high probability trend trade gives you a trade that embraces those advantages. It has the potential to win 70 to 80% of the time. It's the trade that helps you recognize the advantages. It's a trade that's going to build confidence and trust in those advantages. And the high probability trend trade is not your only trade, guys. It's your first trade. It's your foundation. And once you learn it, the possibilities seem endless. So the first hour of every class, especially if you're new in here, is designed to teach you momentum, a clear path, and how to enter on the highest probability trend trade that we teach, guys. And you're going to be given the tools to study. You're going to be given pictures to create recognition. And you will be given a solid plan to follow until you can develop your own plan. I promise you, everything you need to be successful is going to be given to you in this first hour. The next 2 hours of class, guys, or hour and a half, depending on how long the first hour takes, is going to be devoted to your questions. Guys, this is where you are going to get the most out of this classroom. You need to post your pictures, and everything's focused on helping you read your indicators so that you can make your decisions on entries. And your participation, guys, is going to foster the learning. It's important that you present pictures with your chart read, that you tell me what you see so that we can talk through it, right? And if it needs adjusting, we'll adjust it. We'll talk about it. We'll come up with a plan together to fix whatever's broken and to praise what's going great, guys. And that's exactly what you can expect out of this classroom and the easiest way to get to where you want to be. So I'm talking to Tom and Joel. Who else is kind of new in here? Guys, post your pictures in the room. every time you take a trade, post a picture in the room. Every time you have a question, post it in the room. If I say, hey, this is what it is, and you don't see it, go, hey, Mark, I need you to say it a different way. My favorite thing in the entire world, I don't tell my wife, is when you guys ask a lot of questions, because this classroom turns into the most amazing educational spot. So post your trades, guys. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade. Simulate. I want you practicing. I want you getting in there. I want you getting comfortable with the idea of entering the market and exiting the market. Scaling your charts, opening workspaces. Guys, just do it all. But every trade you take, post it in the room. And we'll talk about it. It's a private session with me. And my goal is going to be to get you to the point to where you're following rules. We'll go back and we'll talk about momentum, clear path, and entry every time we have a conversation. And if there's something that you can do better, we'll find a way to do it better. The second thing is use the spreadsheet that I'm going to give you. And I give you mine every day. Every day I drop this in the room. I'm going to do it right now. So if you're looking at the chat box, here it comes. You can download it. There's a button to download it. You can just click it, drag it off to the side if you want, put it on your desktop. There are 4 tabs. 4 tabs, guys. The first tab is trade tracking. So every trade that you take, you should put into the spreadsheet. You should come back and you should study it. You should see what you're doing every day. You should come back every morning and look at what you did yesterday. Talk about the first 2 advantages, most importantly, because I believe in my heart that if you never forfeit momentum and a clear path, it's difficult to not be successful. I believe this 100%. Talk about your wins and losses. Look at your progress. But the most important thing that you can do, guys, is take the feedback from class. So sometimes I'm going to tell you, hey, you did this, and you're going to want to argue. Don't. It's not going to do you any good. You're going to get in your feels. Don't. It's not going to do any good. It's never personal. It's always about getting you better. But if you take the feedback from class and you look at your well-annotated charts, guys, it's going to set you up for the day. And you're going to be like, oh my gosh, I'm not going to trade in determination conditions. Or I'm going to make sure that I don't have divergence on a 50-50 and all these other things that you're going to learn what they mean. So use the spreadsheet, guys. And just really go back and start to recognize patterns, because all we do is trade patterns. We're going to simplify. We're going to talk about the highest probability trend trades you can take, and I'm going to introduce you to what's called a 50-50 trade, which is a medium probability trade. It sacrifices one of the advantages. You're going to rely on your ability to read charts, to manage those trades, to recognize these trades. And the reality is, if you forfeit the lessons from the high probability trend trade, you're going to struggle with every trade after. This is why I'm so adamant. Focus on those 2 advantages first and you'll find a million entries. But you have to know what looks you're going to commit to. You've got to learn these looks so they become easy. Guys, when you're brand new, the market is screaming. It feels like it's so fast. Once you begin to recognize what it means to have these advantages, it's almost like the market slows down and it almost gets predictive. There's trades that I take that I wait 5, 6, 7, 8 minutes to actually take my entry, because I recognize the pattern, the advantages. I just have to let it do what it does so that I can take the trade. And that's where the 101 tab comes in. I've set this up. Each green section is what it means to have the rules met. And then the red section is what it means to have the rules not met. And I always cover both sides, because recognition comes through repetition. And the more pictures you take, the easier it becomes. There's the favorite tab, favorite looks tab, guys, where you're going to start to build your trading plan. And I'm telling you right now, and listen carefully if you feel like you need a little help, if you don't have 50 pictures of what it means to have your rules met, guys, you're doing yourself a huge disservice. If you don't have a written plan of what it takes to get you into the market, you're doing yourself a huge disservice. I can't stress that enough. And then there's ideas on management, patterns that repeat themselves, guys. And this page should be filled out by you, and it should look like the client trades page that I've put together for you. This is almost 400 pictures of Nexgen users using the software. This is entry sequences for longs and shorts on the high probability trend trade. This gets into management for you. This talks about patterns and why you can change your management plan to hold for bigger moves. Patterns that repeat themselves, an entire section on termination conditions. And then for you adrenaline junkies, there's some pretty good NASDAQ information there. For whatever reason, people want to trade the NASDAQ because they see the more experienced traders doing it, but they don't bother to learn the NASDAQ. Guys, I blew out probably 15 accounts setting up that NASDAQ section for you. So this is your path. You can choose to embrace it or you can fight it. It's totally up to you guys. But I'm telling you right now, the people that keep it simple seem to be the people that are finding the most success. The people that do nothing when the rules aren't met, these are the people that aren't coming to me telling me that they need help. So we're going to talk about these 3 rules. We're going to break them down individually. We're going to look at what it means to have them met, and we're going to look at what it means to have them not met so that you can tell the difference between the two. And guys, everything starts on the large chart. The large chart leads the way. If the large chart doesn't say look for an entry, don't look for an entry. And everything starts with strong trigger lines on the large chart. And before we do that, just actually, you know what? We're good. Let's go. Strong trigger lines on the large chart. Easiest lesson you're ever going to get, unless you're colorblind, I suppose. If the background on the large chart is green, the market's going up. You should be looking for rules to be met for high probability trend trades long. If the background on the large chart is red, the trend is down, you should be looking for rules to be met for high probability trend trades short. This is the path of least resistance. This is going with the large crowd. And guys, true story, if you are colorblind, let me know. We'll go through how to recognize this without needing colors. When the background is green, your small triggers, these solid lines, they're a fast moving indicator, moving average. When they are up and above these large triggers, the dashed line, this is your slow moving average. They work together. The space created between the two, when the background is green, the large triggers are green, and the small triggers are green. The space created lets me know that the odds are favorable for the market to continue up. The only way I will ever say that the odds are favorable for the market to continue up is if I have that separation between the triggers. So odds favorable momentum, guys, this is what strong triggers give you. Odds favorable momentum to the upside. When the background is red, the smalls are below the large, and it's the space created between the two that lets me know that the odds are favorable for the market to continue down. You're going to hear me say odds favorable momentum all day. You're going to have me pointing it out. You're going to see it annotated on charts, OFM. Guys, momentum is rule number 1 for a reason, because when you have momentum, the market's likely to continue in the direction of the trend. And when you have that momentum, that separation, those strong triggers, this is the look that it takes to break those key Fibonacci areas. And guys, when you have these strong triggers up and these strong triggers down, this look can actually help cover up some of the mistakes that we tend to make as new users. And with this strength, whether it's up or down on the large chart, you're going to be able to pinpoint on a smaller, faster chart exactly where a little retracement, where the small crowd is likely to fail. It looks like a tail on the large chart. You're going to be able to pinpoint these tails using a smaller, faster chart. So rule number 1, guys, it's a pretty simple look. Let's look at crude oil. Strong triggers down, separation between the small and large. Strong triggers up, that's your look right there. And if we look at the most current bar, my small triggers are down, my large triggers are up, they're touching one another. I don't have momentum. Does everybody see it? Because one of the things that you're going to want to do, if you really want to get good at this quick, guys, is start taking pictures. And draw little arrows, just like that. And maybe say something clever. Like separation between small and large looks like open scissors. Strong triggers. Rule 1 met. Odds favorable momentum. Whee! Whatever you need to do. But this is exactly what it looks like going either direction, guys. Share that link. Go to your spreadsheet. Open up your 101 section. And guys, I'm almost 50 deep. I do this every day. I never miss strong triggers. Call it giddy up to the upside. I don't care. Whatever you need. But guys, that's it. That's your look. That look never changes. Strength is always strength. Momentum is always momentum. And then when the scissors close, when the smalls return to the large, this is weakness. Ooh, that sounded ominous, didn't it? This is weakness. And when I have weakness, anything can happen up or down. Strength, odds favorable for the market to continue. Weakness, anything can happen up or down. Guys, weak triggers rarely break areas. Weak triggers are when deeper retracements happen. Weak triggers are when those key areas typically stop the market and create the bounce. And if you open up again, let's just take a look and see if crude did it at all. We just have areas holding all day long. There's a little weakness and a deeper retracement. There's smalls on the wrong side of the large, and sure enough, it reverses. This is more of a rule number 2 lesson. I'm excited about termination conditions today, but there's weakness and the market retraces. So you're going to see this all day long, guys. Your job is to scroll back, to take pictures, to learn to trust it. Because once you have momentum, you've got that first advantage. And that first advantage, guys, I'm telling you, that's the one that I never do without. This is the core of my trading plan. Once I have that momentum, I've got to make sure that I have a clear path. Remember, the large crowd, guys, the people that move the market, the people that make things happen, they react to those key Fibonacci areas. And when we scroll back to crude oil, you're going to see just how effective they are. These are the people that when they get to resistance or support, they say, all right, trade's over, or it's time to jump in, guys. So you got to know what areas they can react to. This is a map. This is all it is, guys. It's a map of what you're looking at on the large chart. It tells you what each line is. And each line and areas are synonymous. It's the same word. I could change areas with lines and you'd be fine. So what we have are the areas that can stop the market, the areas that can create an untradeable bounce, the areas that might spoil your forward progress, guys. And these areas, you need to learn them. You need to memorize them. You need to say, I need to be aware of divergence highs, lows, support, resistance, yellow 1-to-1s. And it'll take you, I don't know, maybe 7-8 minutes of your life to really recognize these. And then I'm going to give you the recipe to know when those lines may behave as a termination condition, guys. Because when they're not, when the termination conditions are false, when there's none present, you're going to have room to your profit targets. You're going to have the advantage of what we call a clear path. And when we couple that with momentum, we become unstoppable. So if decisions are made at lines, in order to set off the process to determine termination conditions, that's hard to say, price reaches the area. And do me a favor, if you're a note taker, write this down. Price reaches an area. This is what sets off the decision-making process. This is when the buyers may jump ship. This is when the sellers may flood the market with orders. But we wait for those dynamic Renko bars to reach resistance, to reach a divergence high, to reach yellow 1-to-1s. And once they reach that area, all you have to do is ask yourself, where are my triggers? And if your triggers remain below resistance, if your triggers remain above support, these areas are termination conditions. And if they're termination conditions, rule number 2 isn't met. And if rule number 2 isn't met, you can't take trades into that area. You have to sit on your hands and do nothing. Otherwise, you risk falling victim to the untradeable bounce, to the market reversing, to all the bad things that tend to take money out of your pocket, guys. So price reaches an area. If the triggers don't break, sit on your hands. Price reaches resistance. The triggers are below. Don't go long. It retraced to support. The triggers were above. Don't go short. Don't go long. Don't go short. Guys, look at the bounce in between areas. Rule number 2 is going to help you define untradeable consolidation. Rule number 2 is going to keep you from hoping the market continues up. Rule number 2 is going to keep you from wishing the market would go down. Rule number 2 is going to define with unreal accuracy exactly where the decisions are being made. You've got to scroll back and start taking these pictures. Let's do it again. Bum, bum, bum. Where's my picture taken? Guys, you can scroll back on a market, and this is one picture. This is the course of about 6 hours. That's a termination. That's a termination. So is that. This is one. There's one. There's one. And what you'll notice is that when price reaches an area, the triggers remain above support or below resistance. Don't take any trades into that area. And if you scroll back on your large chart, guys, and you go back 10 days, what you're going to realize is that trading into lines absolutely reduces your advantage. Trading into lines becomes detrimental. It's horrible. It's just, it's like you're giving money away. And it takes away your advantage. Is everybody cool with that? Can you give me a why in the room? If you're comfortable with the idea that if price reaches an area, here we go. I put it in my spreadsheet. Let me give it to you. This is the most broken rule. Whoops. Well, there's the rule right there. I'll give you the picture to go with it. This is the most broken rule because we want to be active. We want to be in the market, guys. 90% of my day is doing nothing. 90% of my day is waiting for advantages. And the quicker you accept that, and the more focused you become on embracing that, the faster you're going to find success, guys. So if I can't trade into an area, I have to let it break, right? I need to have room to my profit targets. I have to have a clear path. So if I trade into Fibonacci support, the triggers remain above. This is my sit on my hands. Let's wait and see what the reaction is. Once the small triggers and the large triggers break through the area is considered broken and the path is clear. So once the small triggers, both lines, and the large triggers get to the other side of the fib, the path is clear until I hit the next line. So let's go to the large chart again, and I want you to see this. This is a great example. Both the small triggers and the large triggers get below supports. The path is clear all the way until I hit the next line. You guys are going to pinpoint that one. The small triggers and the large triggers get above these yellow 1-to-1s. My path is clear to get up to that next key area. And once I hit the next area, guys, I have to start the process over. Where are my triggers? I clear the area, support behaves as resistance, and my path is clear until I hit the next area. And guys, I wanted to use this picture because sometimes these areas are stacked. Sometimes the only thing for you to do is absolutely nothing. And it's going to bum you out. It really is. And if you're a high probability trend trader, guys, let it be simple at first. Let it be either a clear path or a termination, and focus on those two for a couple weeks. And then once you're good at it, once you're like, all right, both triggers have to be through, no triggers, I'm not trading. I recognize momentum. Guys, this opens you up for the next trade. And I'm going to tell you right now, you'll probably take more of these than you will the high probability trend trade. This is a trade that we call the 50-50 trade. This is a medium probability trade, guys. And a medium probability trade means that most of your indicators line up for a trade. However, an issue exists, and you'll be able to understand the issue through your chart reading. When you start talking about your advantages and one of them magically isn't there, you found yourself in medium probability range. That's what this is, guys. When I have the best momentum ever, the strongest triggers that I could ever hope for, and my small triggers smash. And I want you to embrace this word, you guys that are losing 50-50 trades. My small triggers smash through the area, 3 to 4 points. And I have odds favorable momentum. It tells me that this line has the potential to break. That's it. It's just potential. But with that potential, with that momentum, guys, there's opportunities to be had. And I'm going to hand you an ironclad, rock solid way to do this. But you have to understand momentum, and you have to talk to yourself about trigger location every time we get to a line. So it's a termination. It has the potential to break, and guys, that potential remains constant until that back line of the large trigger gets below. So these are your termination conditions. Lines on the large chart. Is everybody cool with that? Give me a Y if you're okay. I'm telling you, rule number 2 is the most broken rule. Rule number 2 is the one that I really want you guys to scroll back on a large chart. I want you to dedicate 30 minutes of your day today and just scroll back and be absolutely freaking amazed how often these lines stop the market. Guys, I'm telling you, if you learn to not trade into these areas, you've avoided the absolute biggest mistake that new users make. And I'm telling you, the ability to do absolutely nothing is what sets apart the strong traders from the weak traders, the successful traders from the struggling traders. It's the ability to do nothing. And there's some of you sitting here listening to me going, yeah, that's pretty much my problem is I overtrade. I take too many trades. I embrace hope too much. You just got to learn to be patient, guys. And on those large charts, we're going to use the lines. On the small chart, when the rules are met, when I have odds favorable, when the path is clear, that's when I'll go to the small chart, when the rules are met. And there is one termination condition on a small chart, guys. There is one time on a small chart that I will say that rule number 2 isn't met, that my path isn't clear. And it's 3 divergences in the same price range, 3 losses of momentum in the same price range, 3 light blue lines from a low, 3 magenta lines from a high, guys. Every time you see this light blue line or that magenta line, it says that momentum is lagging behind price. It's done in the background. It uses MACDs and a couple other comparisons, but you'll see it. And on a small chart, you'll see change before you ever see it on the large chart. So if your rules are met and you show up looking for an entry on the small chart and you see 3 divergences in the same price range, rule number 2 is not met. You don't have a clear path. There may be an untradeable bounce. There may be a reversal of the trend. The path isn't clear. It becomes more powerful with weak triggers, rule number 1. And it also becomes more powerful with a head and shoulders pattern. For you guys that have traded before Nexgen, that means that the final pivot is higher than the previous or lower than the previous from a high. And guys, this look might stop the market. This is the look on a small chart, the only termination condition on a small chart where rule number 2 isn't met. So once I have momentum, I get excited. I'm like, oh, here comes momentum. And then I recognize that I have a clear path. Guys, I am chomping at the bit. I can't wait to go to rule number 3. I can't wait to take an entry, guys. And rule number 3 says that I'm going to use a limit order. I'm going to be so precise. I'm going to force the market to come to me. I'm going to use that limit order at an area. Fibs, mid-bands, yellow 1-to-1s. And then once again, guys, write those down. Fibs, mid-bands, yellow 1-to-1s. Any other line, whether it's a divergence line or a pink 1-to-1, it's not a potential entry point. Look at that, the bot's coming in. Fibs, mid-bands, yellow 1-to-1s. And guys, here's the biggest thing to help you be successful as a brand new user. Those lines, those areas have to be inside of triggers. And initially, we're going to insist on favorable large triggers, guys. So we're going to buy or sell a pullback. That little shove that the small crowd gives, that's your pullback. And we're going to buy that at an area, fibs, mid-bands, yellow 1-to-1s, and we're going to let them fall inside of favorable large triggers. Because favorable large triggers, guys, large triggers are just moving averages. That's all they are. Don't overthink them. They're these dashed lines moving averages, guys. But one of the things that's so true is that price loves to come back to the large triggers, whether it's a large chart, a small chart, a range chart, a week chart, a stock chart, a futures chart. Price loves to come back to the large triggers, guys. It happens on the large chart. it happens on the small chart. So what Nexgen has done to help increase accuracy, to lower your risk, is we've created the term favorable large triggers. So the large triggers on your small chart, your entry chart, are going to be smooth. The large triggers on the large chart have been superimposed onto your small chart, and they look like they have steps. When these two triggers overlap, what you've done is you've taken the place where price should correct on the large chart and the point where price should correct on the small chart, and you've turned those two correction points into one correction point. This is where I expect price to return to, guys. It's not an entry. My entry is going to come from the areas inside of these triggers, and I'm going to tell you right now that the more they're spread out, the less accuracy you're going to have. The more they're not riding one on top of the other, the higher your risk is going to be, guys. So the best of the best of the best is two snakes riding piggyback. One on top of the other, large and synthetic, guys. And it doesn't matter if that line is in the large or the synthetic, because the tighter they are, the more likely it's going to be inside of both of them. And that's where good things happen. The white circle is the correction point on the large chart, large triggers. The yellow box is the correction point on the small chart. When we put areas inside of the correction points, guys, that's where the small crowd's most likely to fail. So what we're going to do is we're going to go through, and there's a process to identifying the point where the market is most likely to continue, guys. And I'm telling you, if you study this, you're going to be absolutely mesmerized at how often it works. Everything begins with the fight from the small crowd. So when the large crowd, or when the large chart has odds favorable momentum, when the large chart has no termination conditions, notice that I keep going back to rules 1 and 2. Your small chart's going to look like this. It's going to be screaming to the upside, and that fear of missing out is going to get real, guys. You're going to start saying to yourself, oh no, it's going without me. How am I going to make money if I don't get my rules met? And you're going to be so tempted to just jump into that market. And then the small crowd's going to fight like they almost always do, guys. And that's the reversal bar. This first red bar, after all of these green bars, it says, hey, guess what? Here comes the pullback. The small crowd is fighting. So at the time of the reversal bar, your job is to find your favorable large triggers. Large and synthetic, guys. They should be overlapping. Picture two snakes riding piggyback. Put your hands one on top of the other, guys. That's the look. But these trigger lines are not your entry. This is just where I expect the price bars to come back to. Inside of those triggers, fibs, mid-bands, yellow 1-to-1s. These are the point where the market is most likely to bounce. This is where that tennis ball gets thrown hard as you can. These lines are the wall that you're expecting it to bounce off of. So you will create what we call a window of opportunity. In a long trade, it is the highest point of support to the lowest point of support inside of favorable large triggers. And I want you to start writing that on your chart. Inside of favorable large triggers. Inside. Because this blue box from the highest point of support to the lowest point of support, this represents the point where the market is most likely to continue, where the small crowd is most likely to fail, where the bounce is most likely to happen to send it screaming in the direction of that momentum and clear path, guys. And identifying the window of opportunity reduces risks. By waiting for the pullback, it increases the distance to your target. And guys, you're going to get so comfortable with the idea that price will correct to triggers, but it should bounce off of areas, that you're going to learn to ignore the areas outside of the triggers. Areas that are not inside of trigger lines, guys, are not a part of the window of opportunity. And by the time the market gets here, you've lost your edge. The advantage is gone. This is not a trade that you want to be in. So you're going to activate a limit order right at the top of your window, a tick or two above the highest point of support, guys. And this becomes your entry for the highest probability trend trade long. And one of the beautiful things about futures is we can make money both directions. We can take advantage of a market that is going up or going down. So when everything says down, When the large chart has odds favorable momentum, the background is red, there's no termination conditions, once again, we're going to wait for the reversal bar. The reversal bar on the small chart signals the beginning of the pullback, the beginning of the fight by the small crowd. So I'm going to look for my favorable large triggers. This is my red box, and I'm not going to jump in when price hits those triggers, guys. I'm going to insist on an area inside of favorable large triggers. Fibs, mid-bands, yellow, one-to-ones. And guys, this becomes your entry for the highest probability trend trade short. And sometimes there's only one line, and that's beautiful. Your entry is a tick or two below. And guys, I'm going to tell you from experience, they draw a picture. Your entry belongs right here, below the window, below that lowest point. Because the large chart has odds favorable momentum. The large chart has a clear path. I don't expect the small crowd to be able to get that much work done. And I can't tell you how many trades I see. People putting their entries, their orders above the areas inside of triggers, hoping they can save a couple dollars, hoping that they don't have to look at the market trade against them at all, and they miss the entire move down. So guys, your entry is a tick or two below the lowest point of resistance inside of favorable large triggers. Your entry is a tick or two above the highest point of support inside of favorable large triggers. And once you can define where the market is most likely to continue, you also understand where the market shouldn't go. And this just happens by default, guys. And that phrase, where the market shouldn't go, is going to drive your management plan, because with the perfect entry off the areas inside of favorable large triggers, if price goes 4 or 5 ticks above all those trigger lines, I don't want to be in the trade anymore. My advantage is gone. The edge is gone. And I am going to get stopped out. This will be my initial stop placement. 4 or 5 ticks above the trigger lines for a long, 4 or 5 ticks below the trigger lines for a short, guys. And if the small crowd ate their Wheaties, if they have it in them, I'm going to get stopped out. And there's this idea among traders that losses are bad, that losses are horrible, that losses are a representation of failure. Guys, if all the rules are met, you're going to get stopped out. I promise you, you will take losses. They're a normal, natural part of a positive equity curve. And with this particular trade, anything that wins 70 to 80% of the time, mathematically obligated to lose, 20% of the time, 20 to 30% of the time. It's okay to lose. It's okay to get stopped out. It's okay to not win every trade, guys. But one of the advantages of this methodology, one of the advantages of the precision, is that your stops aren't that far off in the distance. There's no reason to lose an enormous amount of money on a trade that doesn't work. We know exactly where it's failed. And with all the advantages, you are more likely to get a reversal bar in the direction of your trend. That confirmation that price is moving with direction, with trend, with the clear path, and you'll reduce your risk a tick or two below, or a tick or two above that reversal bar. We saw someone in the room yesterday, they had 6 ticks of risk on a trade. Their entry was so stinking precise, there was virtually no risk on the trade. And that's not uncommon, guys. So pinpoint where the market is most likely to continue, you'll be able to know exactly where to put your stops. And here's the tool, how do I study this? And guys, you're going to get this. When the large chart has strength, when the large chart has a clear path, or for study purposes, even when it has the potential to break, scroll back historically and circle a tail. If that tail lines up with an area inside of favorable large triggers, guys, this is your 2 chart trade. This is your high probability trend trade. This is the best of the best. This is what you're studying for 20 days, guys. Figuring out that entry. And I want you to see this. In one bar on the large chart, guys, that one whole bar, the top of the bar is the beginning of your pullback. The bottom of the bar is typically where your entry is, pinpointing that tail. And then the next bar doesn't form until that bar goes all the way up, guys. This refinement chart reduces risk. This refinement chart takes this 8 ticks of potential profit and turns it into 32. Once you can define where the market is likely to continue, great entries create very manageable trades. So you can use this tail idea to go back and study. So let's have some fun. We'll do this one right here with the potential to break, guys. Coming from a termination, odds favorable. There, where'd it go? There's my tail, just for grins. Let's see what it looks like on a smaller, faster chart. Let's go back historically. And this was actually in the middle of the night when the volume is low. Bum, bum, bum. There it is. Your lowest line inside of triggers, guys, was resistance in a mid-band. And it came right back to it. And look at how those triggers were split. It could have gone to either, but it bounced off of the lines, guys. It bounced off of the lines inside of the triggers. Let's develop some trust. Let's go back. Let's find this look. Look at that. The area broke. We'll look at both of these and see what it looks like. If I'm not mistaken, that may not be it. That one, beautiful. That one a little unorthodox. But the pattern's the same, guys. These retracements happen all day long. And sometimes they're going to fit the rules, and sometimes they're not. But you can go back and study this, and you can create that recognition. I love it. Tom, and it gets easier every day. It gets easier every day. It really does. And the cool thing is that it happens on all sorts of different markets, and it happens on all sorts of different time frames. And sometimes you might even get odds favorable momentum, and you get that clear path, and let's see what that looked like. I'm just studying, that's it. That's pretty ugly. My rules aren't met. There wasn't an opportunity for me there. Not every trade is my trade. Not every trade is my trade, guys. But you can go through. Oh, I'm sorry. Z-Robot said that, not Tom. My bad. And get comfortable in not being right. You struggle with now is to draw these and then say, oh, crap, that doesn't meet my rules. And that bums you out a little bit. All right. Every move should be your move, right? Let's look at that one. I'm not sure I was awake. Oh, that was news. That was the beginning of news at 8:30 a.m. Let's see what it looked like. Look how much that market shot up off of news. That one pulled right back to support, headed up. Maybe not your trade. But the cool thing is, Tom, and the reality is that every move in the market can't be your move. And this is only one trade that we're looking for, right? We're only looking for the highest probability trade. Where did that circle go? I don't have it. Show me a picture. But look at that, guys. It's the same pattern. There it is again right there. It's the exact same pattern over and over every day. Here's my momentum. My path is clear, but I don't really have any lines inside. My mid-band's hovering between the two correction points. Eventually, you'll say to yourself, well, maybe if I get a reversal bar, I'll take a trade. Maybe I'll need a little confirmation. And we'll see what happens. But guys, this is what I talk about. Are there any questions about the high probability trend trades? Are there any questions about momentum? Any questions about clear path? Are there any questions about entries? Because this is your foundation, ladies and gentlemen. This is your first trade. And the easiest way to get to where you want to be with this trade is to recognize strong triggers and know what it looks like when you have. Could I draw the rectangle, please? Oh, where we do a bar by bar, Tom? Absolutely, I will. Let me give this stuff away, and that's how we'll start the second hour. Guys, I'm going to give you a couple different things right now. I'm going to give you chart reading 101. And in order to get to your want to be, guys, you've got to be able to recognize some looks. This is taking the most basic concept individually of the high probability trend trade. Take 25 pictures of strong triggers the same way we did, and then take 25 pictures of weak triggers and make sure you know the difference. Take 25 pictures of a clear path when the triggers break through. Take 25 pictures of a termination condition and make sure you know the difference. And guys, I'm going to tell you right now, there is so much money to be made in the futures markets, but if you don't have a plan, you're going to get slaughtered. So make sure you know the basics first, guys. Take pictures of the entries. Learn the looks. Commit the looks. But don't just take the pictures. Talk about the whys. Why is it strong triggers? Talk about the separation. Talk about the colors matching. Talk about the momentum. Talk about it being rule number one, guys. Commit it to memory. So your job is to start filling up this spreadsheet with your pictures. I've already given you a great head start. These don't count as your 25. That's the easiest way to get to where you want to be. The next thing I'm going to give you is the high probability trend trade checklist, and I finally switched them. And this shows you exactly what it looks like to have the rules met. Strength, weakness, there visually. I can police myself. I can make sure that I'm taking the right pictures. Termination, potential to break. It's broken. Window of opportunity, and exactly where my limit order goes. So guys, I'm going to give you that as well. And all of that is going to get you to the KISS plan. When I told you I'd give you everything that you need to be successful, guys, I promise you're getting it right now. I'm about to hand you the KISS plan, the Keep It Simple Sunshine plan, guys. This is a stepping stone in your learning journey. This is the first trade, not your only trade. This is the foundation trade. This is the trade that typically wins 70 to 80% of the time. This is the trade that creates confidence through the memory of success. This is the trade that teaches you to read your indicators, guys. It is designed to optimize your chances of success with the high probability trend trade. Through simulation, study, class feedback, and continuous practice, guys, you're going to create your own trading plan. Once you get momentum, once you get that clear path, you're going to start to recognize patterns. But the idea is that the patterns have to be proven to win more than they lose, and that's what the high probability trend trade does, guys. So your simple plan for consistency. And this is a bummer because it forces you to be patient. Don't fight the large chart. Don't fight the large chart momentum. Don't fight the large chart direction. Don't fight the large chart areas. Go with the flow in the beginning, guys. It makes life a lot easier. So define your entry. Figure out how to get into the market where the market is most likely to continue. This first one, termination that reverses the market, guys. This is what we call a strong top or bottom. This is not mandatory. And you know what? Let me put this in here. Not mandatory. But it helps. And that's why it's included. And there's pictures of what it means to have a strong top or bottom right here in the plan to make sure that you understand. Strong triggers on the large chart, no termination conditions on the large chart. And guys, notice the language. Area for entry inside of favorable large triggers on the 5-1. Very specific. And this is your entry for the highest probability trend trade, guys. All you're doing is figuring out how to get into the market. Has absolutely nothing to do with getting paid. Has absolutely nothing to do with management, with exits, or anything other than getting into the market where the market is most likely to continue. And once you can do that, guys, give me 20 days intently focused on entries. Once you can identify where the market is most likely to continue, you're going to understand where the market shouldn't go. And that's where management kicks in, guys. And management is going to be just as mechanical for the brand new user in the KISS plan as the entry is. It's 100% defined by if then. And your initial stop is going to go where the market shouldn't go. So your initial stop is going to be 4 or 5 ticks beyond that window of opportunity. And once you're in, and once the stop's in place, there's absolutely nothing for you to do. You're either going to get stopped out of this trade, or the advantages are going to come together and the angels are going to sing, and you're going to get a reversal bar in the direction of your trade. And if you get a reversal bar in the direction of your trade, then you will move your stop 2 ticks above it for a short, 2 ticks below it for a long. If then, guys, this mechanical process helps eliminate the emotion, the fear, the arbitrary stop movement because the butterfly's in your stomach. If I get a reversal bar, then I move my stop. If I don't get the reversal bar, guys, I'm getting stopped out. I have to wait for the next trade. But the cool thing is, all those advantages are more likely to give me a reversal bar. And all those advantages are more likely to get me to my first target. And the first target in the KISS plan is $100. That's it. Just $100. It is 10 ticks from your entry on crude oil. It is only 8 ticks from your entry on the S&P, guys. And this $100 target is going to get hit more often than it isn't with this trade. Which means that you're going to get paid, which means that you're going to develop a little bit of confidence. You're going to start to get trust in the idea that you can pinpoint exactly where the market is likely to continue, and it's going to make it easier for you to not hesitate. And once you get paid, you're going to go break even. You're going to eliminate 100% of the risk on this trade. So you've got money in the account and absolutely no risk. And guys, that's designed not because this is the best case scenario, but rather because it's going to make it easier for you to hold for your second target. And once again, guys, the KISS plan is the beginning of the road for you. So the target on the KISS plan for your second contract is only $200 away. Only $200 away from your entry. And if it hits that target, you're going to exit the trade without a care in the world about what happens next. You're going to exit that trade, and you're going to be $300 better for it. $300 on the highest probability trend trade. $300 on the most mechanical management that I know how to teach. And then what happens is the same way through simulation, study, class feedback, continuous practice. On that KISS plan, you'll be empowered to create a plan based on your personal goal or on your ability to read the indicators. The same is true with management. So every picture that you take, guys, is an opportunity to develop a management plan, to post in the room, to go, hey, Mark, is this one of those times when maybe it was appropriate to hold for a bigger target? And we'll talk about it and we'll work together on your management plan. But in the very beginning, guys, keep it simple. Keep it basic, keep it easy. And the most important thing, Z-Robot, I see your charts coming up. When you post in my room, tell me why. Tell me why. Tell me why you went long. Tell me why you went short. Tell me what your advantages were, guys. Always go back to those 3 advantages. Describe momentum, clear path in your entry, but tell me why you did it. Annotate it on your chart. And the reason that I'm a stickler about this, Z-Robot, is because it's not because I can't read your charts. Trust me, I can. But I want you to go back and I want you to know why you did what you did, because it might be so kick-ass that it works its way into your trading plan. And the great thing is that if you always talk about momentum, clear path, and entry area, you're going to know if you took the right trade, but you're also going to know if you broke a rule. And you're going to get to see the repercussions of that rule being broken. You're going to understand why the trade didn't work, probably long before you ever have to ask me, hey, Mark, what happened here? So annotation, guys, is key. Annotation is key. The more you write, the easier it is to study. And that's my first hour, guys. Every hour is the same thing. Every hour at the beginning of class is the exact same thing. It doesn't change. It all revolves around momentum, and the next half of class is 100% dedicated to your pictures, and I will always go back to those 3 things on your picture. I will always go back to momentum, clear path, and entry area. So Z-Robot, here's the deal. Sometimes you're so busy you don't have time to annotate, right? I know this sounds crazy. Don't post it. Because when I click on your chart, You had momentum, you didn't have a clear path, you just jumped in. Why? Why did you jump in from the wrong side of the small triggers? Why did you just jump in without a pullback to an area? Why did you just jump in without a clear path? I can look at it and I can go, Z Robot, kick ass, everything set up and you jumped in long, right? Tell me why. Because I want this to be repeatable, guys. I want you to find success for the rest of your life, not just getting lucky on the one trade. So your trade was somewhere down here, right? And your entry was a jump in somewhere here. Let's talk about it. Let's make it repeatable. There was the pullback. Your entry was somewhere right in here, right? And it didn't quite get you. It didn't quite turn into that trend trade that we were hoping for. But let's make it repeatable. Let's talk about it. Let's make sure that you're focused on advantages, because that's what's going to carry you next level, I promise. Sorry to sound like a nag. But I'm going to sound like a nag a little bit, guys, because what I find is that most of the people that tell me they need help are the people that don't annotate their charts. Most of the people that tell me they need help are the people that aren't speaking to themselves in terms of advantages. Most of the people that ask me for help are the people that don't even have a plan written down, yet they expect themselves to be successful. So, guys, I go full tilt boogie, have a plan, and until you can write your own, use the one I gave you. I just gave it to you in the room, guys. I just gave you Chart Reading 101. I just gave you High Probability Trend Trade Checklist, the KISS plan. I gave you my PowerPoint in PDF form. And guys, I'm going to do two more things. And this is the biggest thing. And I love having this conversation with people. And I love having it because I had to have it. I had to have it with myself. Now Z Robot, you took all the time to type that in the room. You could have just typed it on your chart so you had something to study tomorrow. I know exactly why you did it. I want to make sure you know why you did it, right? I want to make sure you know why you did it. Morgan, email it to me. I have people email me plans all the time. I am more than happy to sit down in the afternoon and look at your stuff. But here's the deal. If you guys send me a plan for review, I need your rules written out, and I need pictures of what it looks like to have your rules met. And guys, the most important thing is if you send me a plan to review, I need pictures of your plan being met. I need to see your long trade. I need to see your short trade. I need to see your management, right? Don't just send me a plan and go, hey, this is what I'm doing. Show me that you know what it looks like to have your plan met. Show me that you understand momentum. Show me that you can define a clear path. Show me your entry, right? And guys, let's make sure that your plan are patterns that work more than they don't. So one of the things that you can do, I'll give you this right now, guys. This is a template to developing your own plan. Here's how you define your entry. 10 pictures of the perfect long, 10 pictures of the perfect short. This is how plans are built. And I'm going to tell you right now, the people that take trades outside of the KISS plan, that do it successfully, they've done this. I know this because I've worked with them. I wanted to show you this. Where did it go? Daily goals. You need to define your entries. You need to define your exits. And guys, you need to define what you need to make every day. And one of the things that tends to happen to people is as they get into day trading, and guys, it's exciting. Day trading is exciting. And you all understand the potential for wealth that comes from day trading successfully. But one of the things for most people is we're not accustomed to daily wealth. And trading book, most people can't even fathom the idea of making $1,000 in a day. And it's true. $1,000 a day is $250,000. Not a lot of America makes $250,000 a year. So prove to yourself that you can win first, guys. This is one of the biggest lessons I think that we all omit is prove to yourself that you can get paid. Prove to yourself, and there you go. Prove to yourself that you can do it. It is. Because if I can make $100 a day every day, guys, I can mirror that on 10 accounts and turn it into $1,000 from the same simple approach. If I can make 200, hell, I can turn it into 22,000 a day. And 3,000, 4,000, 5,000. The idea is learn how to get paid. And learn how to shut it down when you reach a goal. And learn how to shut it down when you reach a stop loss, guys. And this was always my hardest thing to do. Is I have had days, more days, and guys, I'm embarrassed to say this. I've had days where I was up $2,000 and blew out accounts, blew out Apex trading accounts because I felt invincible or I started breaking my rules or I didn't stop when my goals were met. And guys, it's that nasty little phrase, all I need is one good one. All I need is one good one to get it back. And what happens, guys, is once you start thinking like that, your brain's already looking for the money and not the process. So this daily goals is in there as well. Look at it. Realize that wealth can be obtained from base hits. And then finally, I gave you guys one more thing. And that's it, right? It could be trading book. I'm giving you guys one other thing, and this is what I call exit conditions, and that's in the PDF file that I gave you. And this goes back to the challenges that people have been approaching me with lately, guys, is there's two things you have to know before you sit down and it's not simulator. You have to know exactly why you're going to enter. You have to know what it looks like. You have to know what your rules are. And then you have to have an exit plan, guys. You have to know what it's going to take to get you out of that trade. I am the biggest culprit of hoping a move goes further than my indicators tell me it's going and only gets stopped out, right? And I did a lot of that in my trading career. And then, after getting stopped out so much, I would take the perfect entry and I would jump ship at a tick or two because I was so terrified of losing. And the key is to know why. Why will I get in? Why will I get out? And then just commit to having the rules met because the rules have been proven through study, through simulation, through feedback to give you a statistical advantage to produce an edge, guys. And it's the process that yields results. So if I'm in a high probability trend trade, what's it going to take to get me out? Initially, it's just the KISS plan rules. I'm learning to read my indicators. But then I'll start to recognize some patterns. But if I'm in a 50-50 trade, it's a completely different management plan, which means that I have to know the difference between the two. And if I don't, I'm likely to mismanage. And then a momentum trade is different. And then an HVA trade is different. And guys, there's all these different trades, and each trade has a different management plan. So you have to understand what you're getting into to know how to get out. And I think that's where most traders fail, is the exit plan. Maybe you agree, maybe you don't. But guys, that's the end of the first hour. So thank you for letting me go through and talk through it. And then Z Robot, I know I'm a pain in the ass, but absolutely. You let it clear the area, strong momentum. It didn't pull back to the fib though. Pull back to the fib just broke. So you said with everything up, with everything strong, you're willing to just hop in, right? Because this is an absolute freight train of momentum, and you said, well, this thing's likely to go up. Let me hop in. And that's pretty cool. I love this trade, and this looks almost exactly like my trading plan. But you got to know why, right? You got to know that it cleared the fib, and you got to know that there's momentum. And I'm going to teach you something right now. Let me see if I can find that other picture that you posted. One quick lesson. And Z-Robot, you just got bumped to the front of the line. As long as, if you're going to take these jump-in trades, I'm going to give you guys a quick management lesson because people love to jump in. And I call it in the room, I'm like, you guys in your JTFI trade, that's all you're doing. I'm just jumping in. As long as price doesn't close on the wrong side of those triggers, it's going to continue down. Close on the wrong side, it pushes up. Close on the wrong side, it pushes up. Close on the wrong side, it pushes up. And then it continues down, and close on the wrong side, it pushes up. So for you guys that are just jumping into the market, for you guys that are learning how to hold for bigger moves, this is one of the greatest lessons I can give you. As long as price is left of those triggers, whether it's small or large, going up or down, whether it's going up or down, as long as it doesn't close on the wrong side of those triggers, guys, it's going to continue up. As long as it doesn't close on the wrong side of those triggers, it's going to continue down. There's a little management tip. But you guys that are just jumping in, Z-Robot, was that gold? That was gold that you took, right? So we were down here. I want you to see something. Bum, bum, bum. What was your entry? Your entry was 79.7. So you were in right here. Z-Robot, you didn't get a close on the wrong side of those triggers until 82.5, which is almost $300 worth of profit. But you exited, my friend, with about $100 or $420 because it was more contract. So what you can do is, one of the things that you can add is, why did you exit? Maybe it's a predetermined target, right? But every trade, you're identifying large chart, you're identifying entry, and then you're identifying exit. And what we're doing, Z-Robot, is we're creating a trading plan. We're creating recognition of patterns. We're creating the idea that I want this to be repeatable and I want it to be mechanical. Does that make sense? So don't forget your exits either, guys. Because I'm going to tell you right now, like, my feedback on this one, Z-Robot, would be, why the hell did you get out? Everything was going perfect. You didn't hit anything. Let's make more money when there's more money to be made. And that's okay. I'm not beating you up. But this is the process, guys. You post, we talk. Let's see if there's a way to do it better. And if I don't know what you're thinking, I don't know if there's something that needs a little attention. So great job. Thank you for the comeback on that one. And then this is it. So, Tom, you don't need to worry about this right now, right? Right now, your focus is great entries. Your focus is great entries. And then once you can nail great entries, that's when management comes in. But all I'm saying, as long as price doesn't close on the wrong side of these triggers. See the reversal bar? The reversal bar tells me that it closed. All of this was maybe, each one of these little tails was an, oh shit, is that going to be a reversal bar? But none of them were. So if I force it to create the reversal bar on the wrong side of the triggers, then I'll stay in this trade until I get it. Or until I hit an area. Does that make sense? And guys, this is for those of you that find yourselves jumping ship too soon. This helps a lot. It really does. It really helps a lot for you guys that love bigger moves. Just something to think about. All right, I stink at taking breaks, but I'm going to take 5 minutes, guys. I'm going to go stretch my legs real quick. Directly into a termination condition. Does everybody see it? Directly into a termination condition. No short trades, even with the momentum. And did you see how it blew through one correction point and hit the second correction point? And then it came right back through those triggers to the second correction point. And it ended up finishing the move to the fib right off of resistance inside of a trigger. Guys, I can't make this stuff up. So we'll see what that termination condition does to the market. And I want you to do me a favor while I'm taking a break. I want you to say, in your most PC manner, holy shit, look at how accurate those fibs are. I should probably never trade into one. All right, I'll be back in 5. Sorry about the swearing. It. And Rob, you can't piss me off asking me about reversal bar markers. Which chart are you talking about? Large chart or small chart? Okay. Man, that was weird. Did you like have text on there? It quoted me. On the small chart, there is no significance. It's just the point where this bar will become an up bar. I mean, that's all it is. The only thing the reversal bar marker is it tells you where this bar will become an up bar. So at 2484.8, if price makes it to that point, I'll have an up bar. That's it. That's all the reversal bar marker does on a small chart. So if you're waiting for a reversal bar, you know exactly where it's going to happen. That's it. Really nothing else to it. I don't have it worked into my rules anywhere for the high probability trend trade. It's nothing more than an indication of where that bar is going to become an up bar. The same way this one is nothing more than an indication of where this will become a down bar. That's it. Why do you need to know that? You don't for the high probability trend trade. How cool is that? And I'm telling, and Rob, I'm really happy that you asked that question, because guys, it goes back to the premise that that human nature has us trying to find value in everything that we look at, right? And human nature says, I need to rank these and I need to sort these and I need to understand exactly how this all the way over here fits into this all the way over here. Rob, I think it's funny that that's on the bad one. I don't think that is I don't think that's a bad word. You can use it. Just do the space in it. But guys, we do that a lot. Our brains do it, and I don't know why. I don't know why they do it. I think it's because we all try to complicate things, because it's hard to believe that simple is effective. One of my favorite Elon Musk interviews, he's talking about how engineers are notorious for optimizing things that should have never been invented in the first place. And I think that we all do that, right? 3 rules doesn't feel like enough, Mark. I can't possibly have momentum and a clear path and an entry area and be successful with it, because why would you believe it? It sounds ridiculous, right? But if you start to study it, if you start to practice it, if you start to allow it to be as simple as it's presented, you actually find that it is in fact effective, that it is a plan capable of winning more than it's losing. And guys, I've got people that literally follow the KISS plan and could fund themselves in those prop firms in the first 30 days. So it's awesome. Keep it simple, guys. So now I'm going to scroll up to the top of the chat box. I just want you guys to see it. I've got to scroll up like this to get to your pictures. So I'm going to go through. So if I ever miss a picture, guys, I apologize. It's not intentional. What I'm going to do is I'm going to click on them and we're going to talk about them. And if you have a question, whether it's your picture or not, please feel free to ask. Jen gets us going. Smalls above the large, strong bottom, and you took profit at 100. So you bought the fib on the way back, got in a little early, didn't you? Oh, no, you didn't. You're in just above support, potential to break. You get paid at 100, and then you got out at the fib update. And that's perfect, Jen. This is everything you could possibly hope for. Everything you could possibly hope for. It's strong triggers, and it's the potential to break. And there's no divergence, and it's a pullback directly to support inside of triggers, and it takes you right up to that fib update. And I just don't think you could have done that much better. Nicely done. And then Rob, you're jumping in again, right? You're just hoping the market goes. It's so nice to have you back. Yeah, those fib updates have messed with me for the last couple days. I was laughing with my brother about that. So, Rob, your question was, how do you know when to get out? I don't know. What do your rules say, brother? What do your rules say? What got you in? What's the whole basis for you getting into this trade? Maybe the opposite happening is a good reason to get out. Are you in because of momentum? Are you in because of hope? Are you in because it's just a strong trending market and you felt like you should jump in? Like, you've got to define. And when I'm in a strong trending market, I don't know, I guess you just keep going until it stops working. But that's a lot of risk on a trade that is 100% dependent on small chart momentum, in my opinion. I mean, it's a good question. Why? When does it stop? The large chart will tell you. When a reversal bar prints on the large chart, your strong trending market is over. That's typically me. Once I get a reversal bar, it's a complete reset on the strong trending market. It's a good question, but guys, you gotta define. You gotta define it for you. Let me know. Trading book, odds favorable, momentum. You're not sure if this is a clear path, so nope, you're good, man. Large triggers are not a full bar away. You get in at the area inside of triggers. Stopped out 20 ticks. Where did you get stopped out? 42.50, 47.75. You're still inside of triggers though. Trading book. Right? So you're still inside of the correction point. You're still inside of those triggers where you got stopped out. Man, remember when I told you that you need to refine your entries a little bit? No, it's not a gap at all. Gap theory is a large chart thing. That's what defines the mid band as a termination. That's off the table there 100%. Let me give you a little NASDAQ heads up. Your entry chart on the NASDAQ is a 13.2. So trading book, your NASDAQ small chart is the large chart on any other market, which means that it changes the dynamic a little bit. It looks like a 5-1, but it's not. It's a 13.2. These small triggers on the NASDAQ, if they are less than a bar away, and I bet what happened here is it probably went down, hit those triggers, and stopped you out, right? We covered this the other day, where the market should not go. Where the market should not go, beyond the correction point, 4 to 5 ticks beyond the triggers. That's it. It's not a number. It's not a number. All that number is reaction time. It gives you time to put your stop where the market shouldn't go. That's it. That's all it is. But the lesson that's going to help you in the NASDAQ is if these small triggers aren't a full bar away like they were right here, they're likely to act as support. They're likely to act as resistance. See how on this mid-band, whoops, wrong one. Get off of there. On this mid-band, inside of triggers, look at where your small triggers are, and sure enough, it sucks all the way back to them. And this is because it's a 13.2. That happens a lot. So when they're closer than that full bar away, they have the potential to behave as support. And this is where I simply wait for a close on the correct side of them. And if you go through on the spreadsheet a little bit, there's the picture right there of it. And I think that if you just study this for a second, what you're going to find is there's a lot of NASDAQ trades that you won't get run over on. The idea of respecting those small triggers on the NASDAQ pays huge dividends. That one was absolutely perfect. This one closed on the correct side, and there was still an awful lot of money to be made before it changed direction. Does that make sense? And they're all right there in the spreadsheet. It's an arbitrary number trading book. You can say it as many times as you want. I will never change my voice on that. I will never change what I tell you about stop placement. My stop placement, till I go to the freaking grave, is going to be, without question, initial stops are placed where the market shouldn't go. Initial stops are placed where the market shouldn't go. Where shouldn't it go? It shouldn't go beyond those triggers, 4 to 5 ticks above all trigger lines. I promise you that's never going to change. No matter how much you wish I would give you a number, this will always be my answer. And it would have paid dividends on that trade that you took, because you wouldn't have been stopped out. Right? If you had put it beyond the triggers, you would have made money on that trade. Absolutely. And guys, I don't get mad at you when you reword your question to try to get a different answer. My answers are pretty consistent. They really are. Because they're based in 100% patterns. They're not based in fear. I have no fear in your trades, guys. I have zero fear about you winning or losing. It's easy for me to look at your charts, and it's very easy for me to give you the best answer, the answer that makes the most sense, the answer that's going to give you the highest chance of success. And then the only thing that I ask is, eventually you accept it. Eventually you say, oh man, I'm going to give that a try and see what happens. So, good stuff. Where are we? Am I missing trades? I think I missed some. Red Raw. No, I didn't. Here we go. Sorry, guys. When I scroll, I go a little crazy sometimes. All right. Pete says, look what I did yesterday, Mark. I love this. Man, I'll tell you guys right now. Show me what you did yesterday. Show me what you did yesterday. If you have a question about what you did yesterday, get it into this room. This was a counter trend trade, not for the new user. Well, the first one was trading into a termination condition, and you got beat. The second one, oh, you're going to like this. So, Pete, the second one, it's not so much counter trend as it is taking advantage of a termination condition. And you took the trade that Nexgen started teaching in 2004, and it's an edge trade. And what it means is that when you hit this termination condition, when these small triggers roll, all you did is you sold a pullback to the small triggers. This has been a plan for over 20 years, and you took it all the way to the fib, and it was absolutely beautiful. This isn't the right entry, because right here, you're still somewhere right over here. It's that pullback to the small triggers, and it looks exactly like this. Typically, there's usually an area, and it's right at the large triggers. And you can see it on here. It's a great trade, dude, and it's well executed right here. And this is where I love it. And I'm watching those small triggers, and it's almost like leading the passer. And that reversal bar, especially off the large triggers, it's beautiful. You did a great job on that one. First one directly into termination conditions, though. You know better than that. And then here, bad bottom. And it pulls back to the large triggers. Let me read everything. Another counter trend trade, not for the new user. When you enter this trade, the smalls had reversed, but the large were still down in background red. Got stopped out of a short. Entered long at the mid-band. Got stopped out with a profit stop for a small gain. So Pete, the biggest difference between this trade and this trade, no triggers through termination, bad bottom. Huge difference. The entry's perfect. The entry looks exactly the same, but the likelihood of success goes down when the trigger lines make it through that termination. Does that make sense? It's the exact same trade, but the first condition is different. Awesome. And the short, man, that's just a big 50-50 from the top. I like it. It just didn't work. Nice job, dude. Keeping busy. When everything heads back down, 3 divergences. There it is again. It pulls back, right? Everything says down. The smalls are still down. You let it roll and you just capitalize. Absolutely beautiful. I love it. You get caught in the nonsense just a little bit, but then once everything agrees, it really becomes pretty easy for you. Nice, nice, nice. And then, so you try the momentum entry. And I think this is one of the challenges that happens. And I do like the odds favorable, and I do like the clear path. And one of the things that typically works out better is when those smalls are below the large, giving you that rule number 1, odds favorable momentum. And then when this one fails, when I get the close on the wrong side, I'll take a little hickey, Pete, and I'm cool with it. I don't mind giving up 6, 7, 8 ticks. It's no big deal to me because you're good enough to take the re-entry, and you're like, I know this thing with this look, I'll just add on. And that's, to the new user, it seems ballsy. To the experienced user that knows to look here first, it's gorgeous. It's absolutely gorgeous. Because you let the large chart lead the way, and with odds favorable momentum and a clear path, it's difficult to not make money. Nicely done, man. Pete putting on a clinic this morning. Why you trail profit stops. You didn't trail your stop. You would have given it all back. I love it. Get paid. You even give it more room than I would, but that's cool. Get out, right? You can always find the next trade. And then, guys, I want you to see Pete's P&L. This is 11:08 yesterday. Up over $2,000 before lunch. What a great day, Pete. Nicely done, man. And what a great lesson on stops. And I heard you talking about that yesterday as well, guys. Stops. Stops are the difference. Get paid. We're in this to get paid. All right, Pete, next one. Triggers rolled down, separated. Here's that momentum trade where you just jump in and get out. Odds favorable, not a clear path. And you say, yeehaw, let's go to the fib. And then there's your second time you traded into termination conditions, and the second time you lost trading into termination conditions. They're a rule for a reason, guys. I promise. I promise. Directly into a termination condition. Man, that might be a riskier add-on. All that momentum, though, carries it up to the retest. These are tough to me. Adding on to a losing position, everything that I've ever read in my life about successful trading says don't add on to a losing position. And everybody's going to have a different idea. But that one kind of stuck with me a little bit. Everything says down, the path is clear, you jump in and get out of trouble. Really nice job. Odds favorable, clear path, making money. I love it. Steve Diego, 50-50 trade, no divergence. You take a nice entry, and man, it pushes down a little bit. You kept your stop at 71 below the areas, and it worked out beautifully for you. Nicely done, Steve. I like that one. Same trade, right? The bottom of the triggers were at 76. His stop was 71. Kept him safe from the overrun with this look on the large chart, and he was able to get paid, guys. Stop placement. I'm sorry, Tom. Yep. Everything that I'm talking about is the exact same thing, though, and some of these aren't the trades you're looking for. Some of these are feedback and not needing feedback. I'll try to go a little slower, though. But do you notice that I talk about momentum, path, and entry? Every chart, momentum, path, and entry. Those are the three things that I'm absolutely focused on. I'll try and harness it in a little bit, though. Sorry. I get excited. And I know that these guys know their rules, so I do tend to go a little quicker through theirs. What markets are you looking at, Gino? And that might be a good thing. That might be a good thing. Let me open up one more real quick. Let me see where I'm at. That might just about be it for all the pictures, guys. We've got two more, and then we're going to go to the live market, and we're going to do some bar by bars. So here's Steve. Odds favorable, potential to break, gets in low, makes a couple ticks, knows that areas inside of favorable large triggers, missed the entry, would have been a great short. Nice, Steve. That happens sometimes. You had the wrong ES template loaded by mistake. That's scary when you realize that there's a mistake. And then this was Kurt. Says maybe a good discussion. Sorry, Tom. I promise I'm going to try to reel myself in. Feel free to keep reminding me if I go too fast. It's not intentional. It never is. Sometimes I get wound up. I realize this. Strong top. Even though we are gaining momentum, wouldn't the strong top negate a possible long? Absolutely not, Kurt. Great question. Let's do this. This strong top was at 950. That strong top pushed the market down. That strong top helped break this area. That strong top helped break this area. And then that strong top quit working. So this strong top helps with that. But, I mean, this was a strong bottom, right? And this was a strong top. Strong top. Look at that. Look at these, right? This is going to happen all day long, Kurt. What's it say in the moment? In the moment, it says odds favorable momentum, and it says clear path. And one of the things, these strong tops, strong bottoms, this is a great question. It's awesome when you have it, and what it does is it gets me looking for this trade, and if it's a 50-50 trade, it makes me feel better about that potential to break because it's coming from a strong top. But imagine like a highway, right? And this is your highway going off in the distance. And if you start with a full tank of gas, the further you get away from the gas station, the lower your gas gets. And what happens is the further that I get away from a strong top or bottom, the less impact that strong top or bottom has. So if it rolls and changes and gives me a perfect trade, I couldn't care less about what happened an hour ago. It's just too far in my rearview mirror. Great question. Because that's one of the things that might make you talk yourself out of a trade. All right, S&P. Let me circle this one. I'm not sure, Morgan. Smalls above the large. You're trading the NASDAQ though, right? No worries. On the NASDAQ, these pink 1-to-1s, these are termination conditions on the NASDAQ, Morgan. So strong triggers, right? You wait for the close on the correct side. And then you got scared. So beautiful. Great patience, great recognition. Large chart says up. You wait for a close on the correct side. And then you chicken out. I may have done them. I may have missed them. Those are your targets. You've got a 96 to 97 is $20. You've got a $25 target on the NASDAQ. But you're risking 120? $25 target, Morgan? Really? Does that just, if you say it out loud, does it make sense? So he went long. Tom, when you see the blue arrow, and the blue arrow on the left side of the bar, that's a long trade. And then you'll see the pink arrow, and on the right side of the bar, that's the exit of the trade. So when he talks about price closes on the correct side, the trend is up, the momentum is up, he wants to go up, Tom. So if he wants to go up, anything left of these small triggers is the wrong side. That's the downside. Once he gets to the correct side, to the upside, that's what he's calling that close on the correct side of the triggers. Does that make sense? So he went long because the large chart said up, and he went long because the large chart said potential to break. But he knew that on, and Trading Book, this is a good one for you, man. This is what I was talking about. Nope. All right, we're going to go through a quick lesson, Tom. Trading Book, this is what I'm talking about. On the NASDAQ, waiting for the close on the correct side. And it's crazy because it keeps you from getting run over and stopped out when these small triggers are so strong. All right, so Tom, when we talk about triggers, we're gonna back step a little bit. Yeah, wait for that close on the correct side of the triggers. You don't fight that immediate downward momentum. You get in on the right side, and now you're going. You're on the right side. The same way as if I was thinking short here, Trading Book, if I just arbitrarily jump in, that market keeps going up until I get a close on the correct side. Kind of cool, right? So we use this on the NASDAQ for entries, and it keeps you from fighting, because this is a big chart. Keeps you from fighting that momentum. All right, Tom. I got a little confusion for you here. Or I recognize a little confusion. So, trigger lines. Trigger lines are moving averages. That's all they are. And it's the trigger lines that define momentum. And the trigger, as you stated it, you're saying, so is the trigger like the reason for entry? Like it triggers an entry? Is that where your brain was? I just want to make sure. Because you called the trigger the midband. Cool. So when we say trigger, and that's what I thought. I saw that, I was like, aha, we got a great lesson coming right now. A trigger line is these two solid lines run parallel to one another, and this is a fast moving indicator. And it's just called a trigger. You could call it a moving average if you want. We call it a trigger because that's what my brother started calling it years ago. I'll show you why. I'll show you why. And then the large triggers are slow moving. So these are triggers. In regards to his trade, what I said is here's a mid-band, and it's inside of the triggers. And you'll probably recognize that as a potential entry. If we were trading crude oil, if we were trading the S&P, even gold probably, The mid band, whoops, inside of triggers. That looks like an entry point, right? When everything says up, that's where we're getting in. That's the entry point. That's the area inside of favorable large triggers. So you're with me so far? What I'm telling you, and everybody in this room, the NASDAQ charts are at least 3 times larger than the ESCL. The small triggers on the NASDAQ small chart are the small triggers on the ESCL large chart, guys. This is a big honking chart. This is a crazy fast emotional market. This is a market that overruns areas all the time. The volume is crazy. The volatility is insane. This is why I don't really say, hey, new guys, let's go to the NASDAQ. So what we were talking about here, Tom, is on the NASDAQ, and guys, this is exclusive to the NASDAQ. When Morgan got to his potential area for entry, he said, egads and little fishes, my small triggers are down strong. My small triggers are down fast. And he knows that because of the size of the chart, because of the strength of the push, as long as his price bars are on the wrong side of those small triggers, it's going down. So one of the things for NASDAQ is Morgan says, you know what? I'll take the entry from the correct side of those trigger lines. So the mid-band's not the trigger. The mid-band is an area inside of the triggers. And on any other market, I would expect a bounce from there. But because the NASDAQ is bigger, faster, more volatile, nasty, evil, you've got to have a little different level of patience on the entries there. And guys, the NASDAQ is not a training chart. The NASDAQ is not a learning chart. The NASDAQ is a completely different animal. And exactly right, it closed above those small triggers and I'll be darned it went up, right, Tom? And look at this, it closes below those triggers and I'll be darned. It went down. So it's a little thing using those trigger lines to help people that are trading the NASDAQ exercise their patience bone just a little bit to make sure that they don't just get annihilated. And I know this because I got absolutely annihilated. 15 markets worth. I'm sorry. I'm trying not to go too fast, Tom, but not every chart is like this is NASDAQ. This isn't a Tom lesson. What I just did, Tom, is I confused the ever-loving crap out of you because now you're thinking, shit, I gotta wait for a close on the correct side of the triggers. So not every chart is a Tom chart. I know you get that. This is NASDAQ. So if you hear me say on the NASDAQ, just go run a lap. We're not there yet. I do worry about you guys that do it. And guys, that's actually all of my pictures right now. So go ahead, but I'm gonna go through Tom's request real quick. So I'll catch it in a minute. I stopped trading it. All right. So this is the ES. So Gino, are you in here? Gino, you said you couldn't find a trade. Let's go through this right now. So the S&P hit a termination condition and it reversed the market. Cool, Morgan, I'll come back to it, I promise. And it gave me odds favorable momentum. So Kurt, this is for you too, brother. This strong top increases the likelihood that this area breaks. So Gino, did you see the strong top? Did you see the momentum? You might have been watching NASDAQ at the time. Everything is the perfect storm for this market to continue down. Does that make sense, everybody? Strong top, The best momentum ever. Smalls have absolutely smashed through, but the large are lagging a little bit. Well, I'm going to wait for a reversal bar on my small chart. It's a 50-50 trade. There's my reversal bar. So on the small chart, when I get the reversal bar, I have to do two things. First, I have to identify my trigger lines. From the top to the bottom, guys, this is the correction point. Price is going to return somewhere to the large, somewhere to the synthetic, and this yellow box just defines where price is most likely to return to. Does that make sense, everybody? So far, so good. This is the first step. We're finding entries. But the trigger lines are not my entry point. So I'm going to look for areas from resistance to resistance inside of favorable large triggers. And guys, this box represents the point where the market is most likely to continue, the most likely bounce point. Are you with me? The rules say I'm going to activate a limit order just below the lowest point of resistance. My rules say if I take that entry, my stop is going to go up here where the market shouldn't go. Do you see the top line of the trigger lines right there, Tom? So your initial box goes from the top line of the triggers to the bottom line of the triggers. Large and synthetic, favorable large triggers. And then we refine that to the lowest point of resistance to the highest point of resistance. And what can be resistance? Fibs, midbands, yellow 1-to-1s. In this case, I have a fib, and a midband. All of these are points that can make the market bounce. That's it. The midband is the top. So I'm going to go to the KISS plan real quick, guys. And I'm going to take this picture. So we've defined our window. And we know that it's a 50-50 trade. Will everybody give me a Y in the room if you recognize this as not a high probability trend trade, but rather that medium probability 50-50 trade? This is important. It's imperative that you know what you're getting into so that you know how to manage, so that you know what your entry rules are. So I'm going to take my picture again, and just for grins, I'm actually going to put these rules onto this picture. This is the rules. I've got to know them for the 50-50. So am I coming from a strong top or bottom? That's a yes. White is the wrong color. Let's change that color. All right. Do I have odds favorable momentum? Yes. Are my smalls outside of the large? They are. And then no divergence. So my rules say no divergence on the 5-1. Here's one of the things that people don't realize. And guys, you need to understand this for the 50-50. If my rules say no divergence, divergence doesn't print until like the middle of the third bar. Does that make sense, everybody? I don't know this divergence is true until almost the middle of the third bar. So if my rules say no divergence, I've got to let 2.5 bars form before I take an entry, which means that this is kind of out of the equation. Or I say, because of the strong top, this is my entry. And guys, if you're brand new, get in. Lowest point of resistance inside of favorable large triggers. You know where your stop should go. And I'm going to squeeze this up a little bit. And the market comes up, and you're in the market. And your stop's in place. And you're like, okay. And this is the part that gets people, Tom. As long as you're in this window, you're in a bounce point. So even if the market goes up, you're still in the window. Do you see it? Don't panic. Life is good. It's still doing exactly what we expect it to do. Oh, and then we get that magic reversal bar. Let me get rid of our window now. Because now the market has said, I am going with momentum. I am going with direction. I am going with that potential to break. And suddenly, your stop is 2 ticks above it. I sure will, Kurt. And I want you to see something, and this is important, Gino. If I would have put an entry at the mid band hoping I didn't get run over, I missed this trade. If I put my entry at the highest point of resistance, I miss this trade. Does that make sense, everybody? Why do we get in at the lowest point? Because these guys are running like a scalded freaking dog. And I know where my stop has to go. And all that momentum, oh, look at that. It gets me on the first one. But then it goes right to the area inside of favorable large triggers. And it goes down. I would have had to take this one twice. I would have had to take this one twice. No, not at all, Gino. In my personal trading plan, because I'm not in the KISS plan anymore, I'll keep my stop up here until I get a decisive move. But in the beginning, guys, if you get stopped out here, you can re-enter. We're learning how to trust it. We're learning how to put stops in the right place. We're learning how to follow reversal bars. And the reality is, guys, is you're going to get stopped out of trades. But when everything is said and done, guys, when everything is said and done, and you post this picture in the room, even if it's a loser, this is what I want to see from you. Hold on. I want to see on your large chart, odds favorable momentum. I want you to talk about that. I want you to say potential to break, not a clear path, 50-50 trade. And I want you to say entered at lowest resistance, followed reversal bar, 2 ticks, stop me out. Even if you don't get the second entry, ladies and gentlemen, even if you don't get the second entry, what you've done is you've said that this is my rule, this is what it looks like, this is my entry, and what's going to happen, guys, is I'm going to say, this is freaking amazing, Tom. What a great trade. I'm sorry you got stopped out. And I'm going to say, I want you to notice something. That when it hit this mid-band, your rules were still met 100%. And then once you get a little more comfortable, you realize that this is an entry too. You will create a management plan based on your ability reading the indicators. And what you might do is say, I'm just going to keep my stop here until it really starts to get going. Does that make sense? But all we're doing is defining the entry at first. So Gino, there's one opportunity on the ES. And here, we'll put this up here. I'll give you the one with a little annotation too. No, Tom. 2 ticks, you're gonna get slaughtered. Your initial stop is about 12 ticks. And then you're gonna put that where the market shouldn't go. So there's the picture on stop placement. Your initial stop is going to be about 12 ticks. And then you're going to move it. And if you get a reversal bar, well, then you'll put that stop a couple ticks above the reversal bar. And Kurt, I dropped that one in there for you. And then sure enough, it goes down. You're welcome. So there's going to be all of these opportunities, guys, over and over. You're going to see opportunities. And it looks like, Gino, there were definitely some opportunities this morning. So what did this one do? Here we go. That's odds favorable, clear path. Mid-band's kind of hovering in the middle. That's got a line inside of triggers. So maybe not all the perfect ones, but there were definitely. Nope. So, Tom, let's go back to this one and I'll show you. At the time of entry, we'll say this is our entry. Your initial stop is going to be like 12 ticks, right? So if I get in at 31, let me make the math easy on me. If I get in at 31, my software, because of my stop placement, is going to automatically put my stop at 34. So that's your 12 ticks right there. Does that make sense? That's just going to arbitrarily happen. It's going to put my stop in place. Do you notice that my stop is still inside of those triggers? My stop is right where the market has the potential to go. That seems like a silly spot for a stop, doesn't it? So the rules say your initial stop is going to be 4 or 5 ticks beyond the top of those trigger lines. And then if I get a reversal bar, that's my first stop movement. That's where I'll reduce my risk above the reversal bar. So it's very if-then, and it's all outlined not only in the spreadsheet, also in the KISS plan, but your initial stop is where the market should not go. And that should not go beyond those trigger lines, 4 or 5 ticks. And then once I get confirmation that the trade's doing what I want it to do, that's when the first stop movement comes in. And this one would have gotten you because 2 ticks above the reversal bar, they came back and got you. And that's going to happen sometimes. Does that help a little bit? And it'll become more clear. Crude oil's looking at a 50-50. Strong triggers, potential to break. Let's see if this one came to fruition back here. We'll go back historically. Oh my goodness gracious. Did anybody get short at 93? Potential to break. Pull back to resistance right inside of favorable large triggers. Trading book has nothing to do with bar size. Trading book has nothing to do with anything other than where the market shouldn't go. I don't know why you're fighting me so hard on this. It has nothing to do. I don't care. So check this out. Let's do this real quick. I'm going to take this picture and I'm going to take this picture and I'm going to put it on there. And these are 2 different markets. Well, I just screwed that up and put it over there. Hold on. It is. It doesn't have anything to do with stop placement. Guys, give me 1 second. I'll be back in 2 minutes and we're going to turn this into an awesome lesson. Give me just 1 second. I'll be right back. Anything. Don't worry about anything other than the picture of the entry, okay? To the pullback to resistance inside of favorable large triggers. And let me Get rid of all this nonsense to make sure that it's easy to do this. And then I'm going to go to a completely different market. And I'm going to take that picture. And then I'm going to go to a completely different market. And we'll just use this picture for grins, okay? So this is 3 different markets. This is 3 different pullbacks to areas inside of triggers. I'm going to put them all up on the same sheet. So longs and shorts. And this is what I'm trying to relay, guys. And you can't tell which markets these are, right, Trading Book? You have no idea what market this is. When I enter at the area inside of favorable large triggers, my initial stop goes 4 or 5 ticks below the trigger lines. When I enter at the area inside of favorable large triggers, my initial stop goes 4 or 5 ticks beyond the trigger lines. When I enter at the area inside of favorable large triggers, my initial stop goes 4 or 5 ticks below the trigger line. So initial stop has nothing to do with market, bar size, type of trade. It's always where the market should not go. For the high probability trend trade, you know, I'm not going to say type of trade because it may be dependent. We won't do that. It is 4 to 5 ticks beyond the trigger lines. So Trading Book, doesn't matter. Doesn't matter what kind of trade, what market you're in. It just doesn't matter. It goes where the market shouldn't go. Trading Book, see my screenshot. Which one? Which screenshot am I looking for? I don't see one. Oh, there's one up there, but Morgan was first, so we'll get back to it. Morgan, 50-50. You changed your rules on entry. You didn't enter on a reversal bar. You entered way over here and then got out quick. You probably got slipped. But Morgan, you're trading in determinations, brother. You're not giving yourself any room for profits. Not giving yourself any room for profits, man. Does that make sense? You're just not giving yourself any room. You're 6 feet away from a brick wall, and you're ready to run the 100-yard dash. Too many opportunities in the market to hope areas break. Right on. If you enter at confirmation, won't make 40 ticks, only 8 before the reversal bar. Okay. Hold on. Let's have some fun with this. Since you won't listen to me when I put it on my charts. Let me put it on yours. Does this sound familiar, trading book? If the small triggers are a full bar away, enter at the area, don't wait for confirmation. If the small triggers are less than a full bar away, wait for confirmation. Like I said that, right? And I gave you the picture 3 times. But you're telling me, look at your triggers. You did it perfect. What's your point? Why would you re-enter? It didn't make it to an area inside of triggers. You took the trade perfectly. I don't understand what you're upset about. I don't see a re-entry. No, don't you dare put words in my mouth. I say there's 2 ways to look at a NASDAQ entry. I say if the small triggers are a full bar away, take the damn trade. You did. And you got paid. But I also say that if you want to increase your chances of success, don't fight the small triggers if they're less than a full bar away. So, believe it or not, you listened to me and you executed beautifully. If you waited for confirmation on this one, you're not following what I gave you. You did it beautiful. Let's go be mad about something else. If I assume that you entered on confirmation, then shame on you for not learning the rules. That's like saying, but Mark, if I break my rules and I lose, well then that's just all messed up. Dude, I gave you the best way to take the NASDAQ trade. You did it. It worked. I'll be damned. And if you broke the rule and waited for confirmation, there wasn't room to make any money. But what did it do after that? Just for grins. What did it do after that? Did it go down? Did it go up? Did you get divergence? Your point is, okay, if you don't think you have room to make money, where was your target on this? 40 ticks, right? Your stop had to go where the market shouldn't. Your stop went above the reversal bar. It never came close to your stop, and it looks like it's going back down. Just because you didn't get paid right here doesn't mean it's the wrong trade. What did it do after? Show me the picture of what happened after. I feel like you're trying to be upset about something that doesn't need to be a point of upsetting. Or not upset, but you're fighting me where there's not a fight. And I love when you post. You know I do. You know I love it. I love the conversations. But I don't feel like you're listening to me on this one. I feel like we're married right now. Did you read this at all on this from the picture that I posted? I mean, did you take a second and actually read what was written on this? Go back and read it. And if it doesn't make sense, tell me which part doesn't make sense. All right, Gino. We're going to step away from that one for just a second, trading book. Then we'll come back to you. We'll go to belt. Let me know when you're ready, Gino. Belt, medium probability trade. Strong bottom, 50-50, potential to break, pull back to support inside of favorable large triggers, and I'll be damned with all that momentum, you won. Beautiful. Great trade. You need to reload F5. Get your ninja script. Those triggers are wonky. There's one thing that I want you to notice, though. You ready, Belt? At the time of entry, when you entered this trade, you were directly into a termination condition. 100%. The triggers didn't break. Do you see it? So it's not even a 50-50 yet. You're literally directly into a fib. And then can we backtrack to Kurt's lesson? No, no such thing. It's a termination condition. That's it. When a termination condition reverses the market, this is a strong bottom. Kurt, do you remember when I was saying that strong bottom, when it's close to it, it helps a lot? So, Belt, what you had here, and this is awesome. There's your termination. No, not price. Triggers. Triggers, triggers, triggers. Triggers define everything. Triggers define everything. Tom, price reached the area. Do you see it? The divergence low? That's one of those lines that we look for. Where were the triggers? Did they ever get below that line? Never did they? Do you recognize this as a termination condition? Yeah, that line was already there. See it all the way over here? That's from a previous one. Cool. When it reverses the market, when that no triggers through termination reverses the market, this is what we call a strong bottom. Absolutely, Cheetah. What does a strong bottom mean? A strong bottom means that you do squats. No. A strong bottom means that the sellers were in charge. They were powerful. They were killing it to the downside. And when they reached a key area, the buyers said, guess what? You're done. And not only did they stop them cold, but they reversed the market. They created the best momentum ever. So, Belt, what you may not have recognized is that you were trading into a termination condition. But you had the best case scenario to do it. And you also had no divergence on your small chart. And you had one line inside of triggers. It is. It's a divergence low. So, Tom, when we talk about areas that may stop the market, and we have to talk about price reached this line, where are my triggers? Do you remember that lesson for terminations? Price reached the line. Cool. I know I got you now. I got you now. I'm telling you, Tom, you are absolutely making my day with the questions. I can't stress that enough. So check it out. Bum, 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 bum. Ooh, you know what? I may have something even more clear. Let me go to my... guys, I write these little blogs. Here we go. This one's called Pivot versus a Pivot Stop Out. So I'm going to go through and I'm going to run through the whole thing here. So when price goes up and down, it's a pivot. Love pivots, guys. They happen all day long. That's it. It's just a pivot. If there's a loss of momentum at the pivot, you're going to see that cyan or that divergent or that magenta line. This is not a termination condition. All this is a loss of momentum. Does that make sense? And the cool thing is that if price returns to where that loss of momentum happened and the triggers remain below, now it's a termination condition. And if it goes above and below, it's a pivot stop out. And if it returns, so right here, just a loss of momentum. But when price reaches it, there's that recipe. Triggers stay above, Son of a gun, no more short trades. And I think that's one of the things that confused me a lot in the beginning is I would see this pivot with divergence and I would say, oh, that's a strong bottom, that's a termination. But price never reached it. Price actually creates it. Absolutely, I will. And because price creates it, it's not a termination. It's when it actually reaches it and you go through that. There you go, Cheetah. So when we come back to this one, this is from a previous pivot off in the distance. And then when price reached it, it became a termination condition. And then when that reversed the market, it became a strong bottom. And guys, if I'm ever thinking about breaking rule number 2, I better be close to a strong bottom. And then I better not have divergence, and I better be able to have low risk. And I think, Belt, you did that one as well as you could have possibly done it, breaking rule number 2. Nicely done. I don't tell you guys when to trade, but I go back to those 3 very basic concepts. Momentum, clear path, and entry. And we watched somebody this morning lose 2 or 3 trades trading into those termination conditions. There's a time to do it and a time not to. Look at this, Belt. Everything says up, right? Strong triggers, potential to break, right back to support inside of favorable large triggers. Every indicator on every chart says, holy smokes, kick ass. 50-50 trade, 100%. And you trust that momentum all the way up to Fibonacci resistance. I love this trade, Belt. And it all starts on a strong bottom. Great job, dude. Nicely done. Telling you guys, you're going to make mistakes. It's okay to make mistakes. Make all the mistakes. And don't get in your feels when I point out that you trade into termination conditions, because I'm going to look for the happy side too. Steve says, inside a favorable large triggers lesson. Everything says up. Are they really strong triggers, Steve? If the smalls are inside of the large, is it really strong triggers? I want to make sure that if we need a lesson here, let's make sure that we get that lesson. And guys, this is important because if you believe that this is strength, then we really have to revisit. We really have to come back and say when the small triggers are inside of the large triggers, there is no odds favorable momentum. There is no strength in the move. It's literally anything can happen. And guys, sure enough, anything did. And this weakness, despite the clear path, and then divergence, which is even more loss of momentum. Rule number 1's not met. And then this was the lesson, right? Not inside of favorable large triggers, which means that I don't have any idea where that market's going to stop. I don't know where to place my stops. Sync your clock, Morgan. See if that helps. Sync your clock. And then, Steve, even this one, you got the reversal bar, the confirmation. It was short-lived with that second divergence. And you get to the wrong side. It still wants to go up. But without the momentum, it's hard for it to go up. And guys, this is one of those lessons. So if you ever post strong triggers, I'm going to go, wait a minute, the same way I did to you, Belt. If you post 50-50 and it's a termination, and I don't do this to say, oh man, you screwed it up. I do this to say, let's make sure you understand the lessons. Let's make sure that the chart read makes sense. Because I want you guys to be comfortable with identifying advantages and also when the advantages are gone. Cool. Ollie. Not even going to look at your range chart yet. Odds favorable, clear path. You pull back right to the edge of those triggers. Bottom of the triggers was 12, which means 07-ish, and it went to 08. How cool is that? 4 to 5 ticks below. 5 ticks below keeps you safe. and you make money. And you waited for the confirmation bar. Why not this confirmation bar? And Ollie, can I give you one of my favorite looks with the range chart? Is when these are coming down fast, I love getting to the right side of them. I really do. And you trust the antenna bars more? I like the antenna bars. I like the close on the correct side of these super fast triggers. It tends to take some of the stress out for me. Because this one's still into them. I like it though. So for me, and this is the same lesson like on a NASDAQ entry. These super fast entries, or these super fast triggers, Ollie, being on the wrong side of them, look how they act as resistance twice. And then once you get to the right side, it's smooth sailing. And as long as you're on the right side of them, I pay attention to that. I don't use a range chart anymore, but when I did, that was a big deal for me. That kept me from getting run over quite a bit. And of course, you want it to be the perfect storm over here. But this is, it's a nice little patience piece for me, watching those super fast triggers. Does that make sense? Probably right there at the mid-band, inside of favorable large triggers, because I don't need a range chart to confirm that one for me. Actually, I probably would have gotten in at support, because that's what my rules say. But my window of opportunity went all the way down to the mid-band, so I didn't need a range chart for this trade. This is odds favorable and a clear path. Why do I need confirmation? I'm just going to take the trade, put my stop where the market shouldn't go. Good stuff. All right, Gino. Tried the gap, didn't work. So I want to do this. You guys are going to hate this. What direction is the trend? Does everybody see it? The trend is up. I have odds favorable momentum to the upside. I have the potential to break areas. Guys, excuse me 1 second. Be right back. Ellie, hey. Inside. Sorry guys, my dog hates the neighbors. Gino, are you with me? Trend is up, momentum is up, strength is up. Every indicator on every chart is going up. Everything says this market's more likely to go up than down. And you had to go short. Seems like a bad idea, right? Eliminate it. Get this one out of, dude, just get this one out of your plan. It sucks. Respectfully. Guys, this is fighting everything. There's not one freaking advantage to be had here. Not one. And then you're asking about the gap theory. The only way the gap theory is true, and it doesn't matter, is these large triggers have to be below the reversal bar marker. They definitely weren't, because the reversal bar is 10 ticks deep into it. So you didn't have the gap theory, and you fought everything. But there's got to be a point, ladies and gentlemen, there's got to be a point where you say to yourself, it's more important to me to have advantages, and you literally how to commit financial suicide on that one. Does that make sense though? And guys, it sucks because your brain's going to go, Gino, it might go down. Nothing says it's going down. And if you absolutely positively have to fight everything on God's green earth, at least let your small chart roll. But I mean, man, that thing's screaming up. So that's okay. You've got to do these. You've got to post these. You've got to hear me go, holy crap, you're fighting everything. And you're less likely to do it if you hear it. I know I am. Triggers up, strong and separated, odds favorable, not a clear path. You just barely got through the fib. But you take the perfect entry, and then you get right back to that fib, and sure enough, it's trouble. And you exit. And then you get back in with divergence off the fib that hasn't broken, and you've got to sit through it. And it goes. Way to trust the large chart, Pete. Trading book, are you in here? And everybody who's learning stop placement. Where didn't the market go? I love this. Pete knows this lesson. It didn't go more than 3 or 4 ticks below the bottom of those trigger lines. That's why we put stops where we put them. I love that. When I see this happen, my brother loves edge of the synth trigs when everything's up. He loves this because he knows it's likely to stop the market if it's going to go up. And stop placement, Pete, just that was like the best example. I love it. All right, Gino. Had to sweat this one out. Where's your large chart, brother? Is this your large chart for that trade? All right. So let me turn this into something where we can see everything. Hold on just one second. We're going to address all of it, okay? So there's one, and let me get the other picture so that we can see entries. It's so much easier if you give me both of them together, but that's okay. We can make this work. One second, I'm building. Trying to make it so it's legible for me. All right, here we go, Gino. So you were in, and just for the record, that's the gap theory. See how it was a full bar? Let's address that one first. So you've got an awesome top, and you've got the mid band. So if I reach the mid band and the large triggers above the reversal bar marker, mid band is a termination. At least in the moment, the mid band's a termination, and sure enough, that gap theory sucked price right back to the large triggers. So there's your gap theory right there. That's what it ends up looking like. And you're telling me that you got in at 15 and you had a 20-point stop on this trade? You had a 100 tick stop? Okay. Why did it need to work? And then this is the NASDAQ. Okay. So you're saying that just because of a perfect top, you're willing to put, what is that? 2,500, $500 stop because of the good top. And Gino, it's not that you can't find a trade, it's that you're not patient enough to wait for the right trade yet. And then here's the entry lesson, the same one that we talked about with Morgan, the same one that I mentioned, a trading book. When I get to my area of entry on the NASDAQ, and these small triggers are up strong, strong, strong. The highest chance of success, the highest chance of not getting run over on the NASDAQ is to wait for the close on the correct side of the small triggers. It establishes your risk. It puts you on the other side of that fast-moving momentum. And then, Gino, that was your first profit target, which is, I don't know, 10, 15, it's about $100 per contract. And then all the nonsense happens, right? And then it finally goes down and you get out. So, I mean, that's cool. It's a 50-50. It's the gap theory. And I know that you're frustrated right now and you feel like the market isn't giving you what you need. This is the ES. Saying there might be more opportunities than you're seeing. I just feel like there's opportunities out there. Well, and I don't know if you're in this state of mind, and let me just share a little bit about my world. When crashes, guys, when I'm not in the right state of mind, when I feel like I need to make money, that's when I lose money. When I feel like I have to do this. And man, $500 stops, Gino. How many contracts were you trading? That's the equivalent of taking the deed to your house to Vegas because you can't afford to pay your mortgage and you're hoping that the roulette wheel gives you the mortgage money. So that's $1,000 risk. And I'm sorry if it sounds like I'm beating it up. That's $1,000 risk into a termination condition. That's $1,000 risk against the gap theory. That's crazy. That's dangerous. You can do it if you want. It's your trading. Man. That was a strong bottom or a strong top, right? Right off of resistance. Doesn't mean that I'm going to put $1,000 worth of risk on a mid-band short. Weakness. I just think one of the things, I'm going to share a story because we're getting to the end of class. I had a gentleman, and I say gentleman, he was a wonderful human being. He was such a nice guy. And he called me one day. He goes, Mark, I got to talk to you. And I said, all right, let's talk. Um, okay. So you knew that it was a ridiculous stop, but you did it anyway, right? I know I'm allergic to peanuts, but I ate them anyway. Because, I just wait and see if I died this time. So, story time, guys. I had a gentleman send me a message. He goes, Mark, I gotta talk to you. I gotta talk to you. I gotta talk to you. And I said, okay. So I picked up the phone and we talked. And he told me, and guys, I love this story. He told me, he goes, respectfully, Mr. Novak, I think you're full of shit. And then Gino, check it out right now. That's your gap theory, brother. Looks like that. Um, he goes, respectfully, Mark, I think you're full of shit. I think Nexgen is full of shit. I think this trade plan is full of shit. And that's cool. Like, that doesn't bother me at all, guys. I want everybody that comes to Nexgen to feel that way. And that's okay. This is why I gave you the KISS plan. This is why we talk about advantages. This is why we define the best of the best. And he told me, Gino, what you just told me. I can't find a trade. I can't find a trade. I can't find a trade. Your plan is absolute bullshit. And what happened, and man, I'm sorry, I'm swearing too much, but this is what he told me. I'm quoting, we're good. I said, do me a favor, my friend. Show me your last 10 trades that fit the plan that I introduce every day. Show me your last 10 trades that follow the rules. And he sent me 10 trades, and not one of them followed the rules. If it was a 50-50 trade, it was riddled with divergence. If it was a high probability trend trade look, he was getting in on the wrong side of triggers. If it was a good looking entry on the small chart, he was trading directly into termination conditions, guys. And he was 0 for 10. And he spent about a week in the classroom, and we did some side study. And guys, I don't do that anymore because the classroom gives you the opportunity to. He was trying to learn it on his own. He bought the software. He was trying to do it himself. And we cleared up every misconception that he had about strong triggers. And we cleared up every misconception that he had about termination conditions. And we cleared up every misconception he had about what creates success on a 50-50 trade. And I said, do me a favor, you wonderful human being. Give me 5 days. Now that we've fixed the mistakes you've posted in class, we've talked about where you were going wrong, give me 5 days on the KISS plan. Give me 5 days where you don't look for every trade, but rather you look for the best trades. And he called me back 7 days later. 7 days later, and his win percentage was in the 90%. 7 days later, it wasn't that he couldn't find a trade, is that he was finding all of the wrong trades. It wasn't that the plan didn't work, it was that he didn't understand the plan. And guys, if you're struggling and you believe that you can't find trades, you might be, you just maybe don't understand the rules well enough, which means that I need you to post to my class. I need you to ask questions. And guys, just show of hands, if you don't mind, is there anyone in this room that went batshit crazy and couldn't find trades and then came back to the KISS plan and it smoothed it all out for them? Anybody other than me? No, I don't have variations on the KISS plan, Ollie. I don't have variations on the KISS plan. What you're looking at is Pete Woodsworth's own private plan. It has nothing to do with me. But I'll tell you that Pete learned how to read his indicators. And then he created a plan that suits his needs. And guys, I see it all the time. I see people all the time that get sideways and come back to the KISS plan and do great. So, Tom, I teach on the markets that I think are the best for beginners, crude oil and the S&P. Does it feel like it, Gino? You ever go to church and it sounds like the pastor's talking directly at you? It's totally inadvertent. I never said Gino. But if it feels like the message is strong, if it feels like the message is pertaining to you, then it probably is. So, Tom, 4 to 5 ticks is different for every market. It has nothing to do with the money, though. It has to do with the location. But 4 ticks in crude oil, so every point, there's 10 ticks in a point. So every tick in crude oil is worth $10, and there's $100 per point. If you go to the S&P, not even close to a strong top, Gino, not even close. If you go to the S&P, each point is 4. It's quartered. So on the S&P, each tick is worth $12.50, and each point is worth $50. So 1 tick is $10. In the S&P, 1 tick is $12.50. In gold, 1 tick is $10. In the NASDAQ, 1 tick is $5. So every market's different. You can go to the CME website and get all of those. But I use them for targets, right? If I'm trying to make $100 in the S&P, it's only 8 ticks. In crude oil, I have to go 10 ticks. If it were the NASDAQ and I'm trying to make $100, I'd have to go 20 ticks. Hold on, let's do this. Futures tick values. Let's see if we can find it. What is a tick value in futures? How much is 1 tick on the ES? So you can go through. Here's a good one. Tick size examples. So it'll talk about it and stuff like that, and that'll help. But for the ES, it's $12.50. For the S&P or for crude oil, it's 10. So Gino, the reason, and let me go back to why I said I won't even embrace probable, because this had the potential to be a good top, and this was the potential for a good top, and it's going to happen all day long. And right now, all I see is trend up. All I see is triggers up. All I see is every indicator that I own up. So until stuff starts rolling, why even think about it? Why even think about good tops and bottoms? I know, but if you already say, this is a probable good top, do you know what it means? It means, Gino, that you're already thinking short. You're already saying, I can't wait to go short if it becomes a good top. My brain says, with everything saying up, I hope this shit breaks. I want to go long. I want to go with the trend. I want to go with the momentum. I want to go with the direction. I want to go with my indicators. I'm so far away from a short, but I am so close to a potential long. Does that make sense? And let me go back real quick. And this is, Gino, you may love this. I've done this. As soon as I start forming an opinion, and this is all about me, not about you, and I go short right here and it doesn't work, this is me as a brand new user, I go short here, and I go short here, and I go short here, and I try it again here, and I try it again here, because I'm so married to the idea that I wanted to be in a short that I lose track of what my indicators are telling me. You're thinking short if it's a good top, and you think long if both go through and not a 50-50. Man, Gino, that stopped the market cold, didn't it? That termination stopped the market cold. That termination stopped the market. So impactful that your triggers never rolled. I love where it's coming from. This is yesterday, man. This is almost 2 hours ago. It's going up until it's not. And this is where doing nothing pays dividends. This is where doing nothing pays dividends, guys. There's just nothing to do. Go make a sandwich. Let me make sure I didn't miss a picture as we close out. I don't think I did. If I missed a picture, let me know. The other Mark says, this quote hit hard with me. The biggest difference between profitable and unprofitable trading is profitable is boring and repetitive. Unprofitable is exciting and varied. When I make the most, it's the same setups, it's the same risk, it's managed exactly the same over and over. Amen, Mark. 90% of your day is waiting for it to be perfect. 90% of your day is doing absolutely nothing. And 100% of your day should be doing the same thing you did yesterday and the same thing you're going to do tomorrow. And guys, this is why if you don't have a plan, you're setting yourself up for failure. If you don't have a set of rules to get in and get out, you're allowing that little devil to sit on your shoulder. You're allowing that influence to come in and tell you, man, you have to be short. Look at Fibonacci resistance. There was a divergence. One tiny little indicator says down, go short, go short, go short. Because if you're not the first person in, you're never going to make any money as a day trader. And guys, that is utter crap. We don't control the market. We have absolutely no influence over the market. And this is, I haven't shown this one in a while. This guy does. Everybody understands sharks and remoras, right? Guys, sharks are the apex predators. Sharks are afraid of nothing except maybe killer whales. And these are the people that move the market. And these are the people that react to areas. And these are the people that create trends and momentum. And all we have to do is go with them. And when this guy's in a feeding frenzy in Gino, that means at a fib. The safest thing to do is to let him do what he's going to do. Because there's going to be something left over for you guys. There will be a piece of the pie. Whether he breaks or whether it rolls. There's going to be something for you. And you've got to trust your rules enough to believe that the next trade is coming. And the guy that tries to be first, right? That's the guy that tried to get the gap theory against everything in the belly. And guys, patience sucks. That is not a nurse shark. Patience is the pain in the butt. Patience is a huge pain in the butt, guys. Patience means that you have to do absolutely nothing. Is that not a white shark? No, that looks more like a reef shark, but either way, definitely not a nurse shark. Look at the teeth. But I think that you know, so now, even right now, everything still says up. We're getting that reaction, but it's not even close to a good top yet. And who knows? I don't know what's going to happen. And guys, patience. Embrace it. Go with it. And Tom, I'm sorry that I go so fast. I'm gonna write a note on my desk tomorrow to slow down when I go through people's pictures. And guys, my whole goal is to get you focused on the idea that you don't have to be in every trade. My whole goal is to get you, yeah, but this doesn't have any remoras. I need one with remoras. Is that a nurse shark, really? No, that's a nursing gray shark. Oh, gray nurse shark. Wow, look at that. I'll be darned. Gino with the marine biology. I'm thinking there's another look for nurse sharks, though, isn't there? Yeah, I guess you're up there, huh? That's the one I was thinking of on the nurse shark, and I was like, there's no way. Looks like a big catfish. And it wears the hat, so it's easier to tell. Right on. Little marine biology.